Now we start chapter 10. In the last chapter, we talk about measuring risk and return based on the historical data, and we also talk about how diversification can help to reduce or lower the risk of a portfolio. In chapter 10, we're going to apply what we understand about risk and return and try to estimate the risk and return for the future. So after this lecture, you should be able to understand this concept of risk premium. And we'll try to apply the capital asset pricing model, what we call as the CAPM model, to estimate the required rate of return for a stock in the future. In the CAPM model, there is an important variable called beta. We'll introduce what is beta and how beta is used to measure the risk. At the end of this chapter, we'll talk about the concept of market efficiency and what different levels of market efficiency means. We'll start with the concept of expected returns. In the last chapter, we talked about the return and risk based on the historical data. So what we calculated was the so-called historical return. If we look forward, or say look into the future, we are talking about the expected return, the return that we expect for a stock in the future. So if you think about the future, a lot of things can happen, or say there could be different scenarios. Under each scenario, there is a possible return. We can try to calculate the expected return as the average of different returns in each scenario and the probability of that scenario happening. And of course, that requires us to have a good idea, good understanding about the probability of that scenario. So if we are looking at a hypothetical stock, and let's just say there could be 3 scenarios in the future. If we say there is a 30% chance that economy is booming and this company, this stock will benefit from the booming economy, so the return under this booming economy, or say this scenario, will be 20%. So that's P1, the probability of 30%, multiplied by the return under this scenario, so that will be the 20% here. But that may be too optimistic. So if we think the economy is going to be doing just okay, not that great, the chance of having that is 50%. So it's more likely to have a somehow sluggish economy. And under this sluggish economy, this company's stock will have a return of 5%. So then we'll do 50% probability multiplied by the 5% return under this scenario. That would give us the 2.5%. If we think there also could be a recession, and the chance of having the recession is 20%. Under recession, the investors actually can lose 15%, or say the return as a negative 15%. And if we use 20%, P3, multiplied by the negative 15%, that will give us a negative 3%. So if we think these 3 scenarios are all that could be happening in the future, and we have a reasonable estimate of the probability of each scenario occurring, then we sum these up, we get a 5.5%. Essentially, that's what we are doing here. Under 3 scenarios, the P of each scenario multiplied by the return under each scenario, and then we sum all 3 scenarios up, and we get the expected return of 5.5%. We can also estimate the risk, expected risk, based on the same idea. However, the standard deviation calculation can be a little bit more complicated than just a simple weighted average, so we're not really putting the formula here. It's not going to be required for your exam. So this expected return idea is just a theoretical framework for us to think about the future. what could be happening in the future, and if it happens in the future, how much would be the return for the security that we are looking at. This equation itself doesn't provide too much practical guidance in terms of how to really estimate the return in the future. However, under this idea, the researchers actually can develop different models based on different statistical distributions about the probabilities and try to estimate the expected returns in different models. But again, that's a little bit too advanced for this class. Now let's introduce the concept of risk premiums. So think about this. If you have a 10-year treasury bond, and as we recall from chapter 7, treasury bonds usually are considered very safe or risk-free investments. So if we can expect 3% return from this risk-free investment, and then we only expect a 2.5% return from a common stock such as Tesla. If you follow all the news, you understand Tesla stock can be very risky or volatile. So the question is, given a 3% return from a 10-year treasury bond and 2.5% return from Tesla, would you want to invest in Tesla stock? Again, treasury bonds, they have higher returns, 3% here, and very low or even no risk. And then you have the Tesla stock that can be very high risk, high volatility, but here it's offering a very low return. So we can understand that no rational investor would pick Tesla or say would be willing to invest in Tesla stock if they expect a low return from this high risk Tesla stock. So what does this tell us? It tells us that if companies like Tesla need to attract investors, they need to give investors higher return, definitely higher than what treasury bonds can offer. In other words, investors, they would demand a risk premium, or say extra return for taking the extra risk. So this risk premium is really a reward, or you can call it a compensation for the investors to get the investors to take risks and invest in risky assets instead of buying a risk-free asset such as a treasury bond. And now if we think about the whole stock market, remember back in chapter 9 we talked about no matter how you diversify your portfolio, even if you invest in the whole stock market, you cannot completely eliminate the risk because the overall stock market has a risk that just simply cannot be diversified away. So in that case, if investors invest in the stock market, overall, they would demand a so-called market risk premium. So again, even if they diversify their portfolio, as long as they invest in the stock market, there needs to be a so-called market risk premium. According to the historical data, since 1950, the average market risk premium has been about 7 to 8% per year, and that is when you try to compare the return from the overall stock market and the risk-free return, or say the return from the risk-free assets such as the treasury bond. And of course, because of the volatility in the stock market, the actual risk premium from the market during each year or during a particular decade actually can vary. So here you see we talk about two terms here, the risk premium and the market risk premium. Risk premium is a more general term that applies to all different kind of stocks or risky investments. So different stock, different investment, they would have its own risk premium. And then the market risk premium is the risk premium that's from the overall stock market. Once you understand the concept of risk premium, we can try to use the so-called capital asset pricing model to help us capture a stock's risk premium and use that to estimate the so-called required rate of return of a stock. The capital asset pricing model, or say the CAPM model here, is about the relationship between the required rate of return of a stock and its beta. So as you see from the formula here, the required rate of return is estimated as the risk-free rate, which is usually the return from, say, the treasury bond. And then second component in this equation here is beta multiplied by a market risk premium. Some stocks may have a higher risk premium than the overall market risk premium. Some stocks may actually have a lower risk premium than the overall market risk premium. So we use beta multiplied by the market risk premium to measure the risk premium for a stock itself. Then your question may be, okay, what is beta? Beta is actually about the sensitivity of a stock or a portfolio to the market risk. So if we have a stock that has a beta greater than 1, we say that stock is more risky than the overall market. And if you use the high beta, for example 1.5, multiplied by the market risk premium, the result apparently will be higher than the market risk premium itself, right? So that's telling you that stock has a higher risk premium than the market risk premium. Can you think of a high beta stock? This is the information for Facebook from the website Yahoo Finance. And if we look at the beta provided by Yahoo for Facebook stock, we see it's about 1.2 here. So Facebook is usually a high beta stock. And now if we think about companies or stocks that have a beta lower than 1, say 0.5. And if you use 0.5 multiplied by the market risk premium, the result is just half of the market risk premium, right? So it's lower than the market risk premium. So that means that stock's own risk premium is lower than the market risk premium. So can you think of a low beta stock? Many of you may have your phone and data service provided by Verizon. And Verizon has a beta of 0.47, even lower than half. So you can imagine Verizon's risk premium is very low, much lower than the overall market risk premium. So again, according to the CAPM model, the risk premium of a stock should be based on, I'll say that should be a function of the risk of the stock. According to the CAPM model, the risk premium of a stock is proportional to its beta. Or say it's actually the product of beta multiplied by the market risk premium. So higher beta of the stock, then higher risk premium for that stock, and then higher required rate of return for that stock.